You know the feeling. It's late, you're scrolling through real estate listings, and you see it. A kind of sad-looking beige box they're calling a starter home for $500,000. If you've ever just stared at the screen and thought, how? Well, you're not alone. Today, we're going to pull apart the numbers behind that insane price tag.
And that's really what it comes down to, isn't it? That feeling that you missed the boat or that the market has just completely lost its mind. It's not just a feeling, it's a mathematical reality. So let's just walk through that brutal math step by step.
Okay, so this is the real question, not who can a bank be convinced to give a loan to? No, we're asking who can genuinely, truly afford this house without basically signing up for a life of nonstop financial stress. And believe me, there is a huge, huge difference between those two things.
To get our answer, we first have to figure out what that $500,000 house really costs you every single month. Because I'll tell you right now, it is so much more than just the mortgage payment you see on a calculator. So we're going to build our total monthly payment by adding up 5 key pieces. Let's take them one by one. All right, let's start building this thing. The first and, the biggest piece is your principal and interest. So let's say you somehow manage to scrape together a 10% down payment. That's $50,000 in cash, by the way. You're still taking out a $450,000 loan. At today's rates, bam, that's about $2,850 a month right off the top. Okay, on top of that, we have to add property taxes. Now, this varies like crazy depending on where you live, but a pretty conservative national average for a house this price is around $6,000 a year. So broken down monthly, that's another $500. Next up, you got to layer on homeowners insurance, which, wow, has that been skyrocketing lately? Depending on your area's risks, fire, flood, whatever, it is super easy to add another $300 to the monthly bill. And then comes the one everyone forgets, maintenance. The 1% rule is a good rule of thumb. It says you should budget 1% of the home's value every year for repairs. So for our house, that's $5,000 a year or $417 every single month. And finally, because we only put 10% down instead of 20, we get hit with the penalty, PMI, private mortgage insurance. It's basically a fee you pay for the crime of not already being rich, and it easily adds another $300 to our running total. Okay, you ready? Let's add it all up. The mortgage, the taxes, the insurance, the maintenance budget, and the PMI. The real monthly cost for this quote-unquote starter home is $4,367. And that's assuming the water heater doesn't explode. So we have our monthly cost, $4,367. Now for the second and maybe even more important part of this investigation, what kind of income do you actually need to support a payment that big? This is where the math gets really, really cruel. Okay, so there are 2 main rules here. You've got the financial advisor rule, the SMART rule, which says your housing should be no more than 28% of your gross income. But then you have the bank approval rule. They'll often give you a loan as long as your total debt, we're talking cars, student loans, everything is under 43%. And that gap right there is a trap where so many people get into serious trouble. So let's work backwards. To keep that massive, almost $4,400 payment at a responsible level, that 28% rule, your household needs to bring in about $187,000 a year. And even if you stretch it to the absolute razor-thin limit that a bank might approve, you're still looking at $150,000 annual income. And here it is. This is where it all hits home. Only about 10 to 20% of US households actually earn that kind of money. Let that sink in for a second. By any responsible financial measure, a starter home at this price is completely out of reach for at least 80% of the entire country. But people still do it, right? They stretch. So what happens then? Let's move away from the abstract numbers and look at what this financial stress actually looks and feels like for a family. So let's imagine a family making $160,000 a year, which is, solidly upper middle class. After taxes, they bring home about $9,500 a month. Okay, now subtract our massive housing costs. Then subtract all the other essentials, car payments, student loans, groceries, utilities, and what are they left with? Less than $2,000. For everything else, savings, an emergency, putting the kids in soccer, good luck. This is what being house poor actually feels like day in and day out. It's that constant low-grade hum of anxiety in the back of your mind. It's being one flat tire, one sick pet, one unexpected expense away from total disaster. It's a kind of stress that just completely eats away at any pride or joy you felt on the day you got the keys. Now, I want to be really clear. This is not a personal failing. You cannot budget your way out of this problem. It's not about avocado toast. It's a systemic issue. It's a market that has become completely, utterly disconnected from the financial reality of most people's lives. I mean, this chart right here, this tells the whole story. Since 1990, while the median income has gone up about 180%, home prices have exploded by 400%. The gap between what people earn and what a house costs has become a chasm. The math, it just doesn't work anymore. And here is the really harsh truth. No one involved in the transaction has any financial incentive to stop you from making a terrible decision. The lender, the real estate agent, the seller, they all make their money when the deal closes. Whether or not you can sleep at night 6 months from now, that's just not part of their equation. So what are you supposed to do? What's the move? Well, you can do something kind of radical. You can look at these numbers, see that the game is rigged, and simply choose not to play. This right here is the key mindset shift. The goal isn't just to own a house at all costs. The goal is to build a life that has financial freedom. And being trapped by a mortgage on an asset you can barely afford is the exact opposite of wealth. It's a prison. Real wealth, it's having breathing room in your budget at the end of the month. It's being able to handle an emergency without going into debt. It's security, it's consistency, and it's the absence of that constant financial anxiety. It is a life that a massive mortgage payment frankly makes impossible for most people. So the final question you have to ask yourself isn't, can I get approved for the loan? The real question is, will owning this house genuinely make my life better? Or will it just make me a conduit to transfer all my money to a bank while I stress about property taxes? When you run the honest numbers, for most of us, the answer becomes uncomfortably clear.